Good morning. It is January 4th, 2023. This is Rob Sin at CEO Technician on Twitter, at Goldfinger on CEO.ca. And I've not made it a secret that I'm bullish on the uranium sector and, nuclear energy as a theme, as a secular theme over the next decade, or perhaps even longer than that. It's kind of hard to forecast or look out past a decade. Uh, it's tough to look out for a year, in this environment. We make forecasts and they're fraught with risk and lots of room for variance and error. But the nuclear energy theme is one that's really easy to understand. It's very clear. It has been gaining momentum for the last couple of years. Most recently, German politician called for a review of Germany's exit from nuclear energy, and he resigned in protest to the fact that the prime minister the chancellor is not paying more attention to nuclear energy and potentially refurbishing the existing, nuclear power plants in Germany and extending their life to save German people money and create more energy independence, because they have those power plants operating there right now. Why shutter them? Also, this news from Indonesia, 2039 is a long way away, but this is a long lead time sector. This is a long lead time industry. It takes a long time to build nuclear power plants. It takes a long time to permit them. The plans have to start at some point. But once the ball gets going, then the world needs a lot more, nuclear fuel, more uranium. So, and there's so many countries that are greenlighting constructing new nuclear power plants over the next decade. China, India continue to build dozens of nuclear power plants, and dozens more are planned in the future. And we're seeing, Western countries also really take a U-turn on, nuclear energy, most notably recently Poland. So I think we're going to just continue to see this trend pick up steam. And that is why this sector has such strong tailwinds. We need more uranium. We're going to need more. And in order to generate that increased supply of nuclear fuel, we need a higher incentive price. Big picture for the sector, the URA continues to consolidate within this pennant. And I would absolutely call it a bullish pennant because of how high up it is in this structure. So this is a big impulse leg from, let's call it $7.50 to nearly $30 a share during 2020, 2021. And now we're consolidating around $20 a share. So that's a standard pullback consolidation after a very strong surge over less than about a 20-month time frame. And now, we're coming into the apex of this pennant, maybe February, March, could even be April. But at some point in the first half of 2023, I expect this to resolve, and odds favor an upward resolution. So if odds favor based upon fundamentals, based upon technicals, if we add it all together, if odds favor higher prices by, let's say, the end of 2023 for most stocks in the uranium sector, then we should be thinking about how to position for that, how to benefit from that. If this does break out, we are looking at, I would say, a minimum 50% move from today's price, and potentially quite a bit more. But we always want to be conservative, and we want to also clearly assess the risk. So the risk for me, this is a level I've stated repeatedly, 1750 on the URA is sort of my line in the sand. If we get a monthly close under 1750, then that would negate this bullish chart interpretation I'm talking about today. So we're risking about 10%, maybe 12% to make 50% or more. I like that risk relative to the potential upside. The risk is relatively modest compared to what I could stand to benefit, I could stand to gain over the next year or so. So, three companies that I want to focus on. I'll mention four, but three that I own that I want to focus on. The first one is the largest Cameco CCJ on the NYSE, about a 10 billion US market cap. This company is a producer, it is a miner. It has fully permitted, uranium mines in Canada, and it's on the NYSE. Obviously, it is sort of the keystone stock in the sector. But recently, they made a big acquisition of a nuclear servicing company, so they vertically integrated across the nuclear energy sector. So it's no longer a pure play uranium miner. And Sprott Equity Research wrote this research report yesterday saying that because Cameco has vacated its role in the uranium sector because it's now diversified into downstream services, they're moving UEC as the go-to stock in the uranium mining sector. That's kind of a curious thesis, in my opinion. The market seemed to yawn at this. It didn't really have much of a move in the share price, but it was also a down day across the market. But I don't think the fact that they've diversified into downstream services has vacated their role as a uranium mining company. Obviously, they still have ample exposure to that. So Cameco would be, in my mind, especially because they vertically integrated, the lower risk stock that I'm talking about today. But this is a volatile sector. So what does lower risk mean? Well, it could still drop 20 or 30% in a major market downturn, a major sector downturn. So that's about your risk, maybe 20%, I would say. And what's the potential upside? Well, probably to about $30 or $32 a share. These 2022 highs over here. So again, the risk is relatively modest relative to 40 to 50% of upside from about 22.50 a share. And notice how CCJ has been moving up in recent weeks. I did a video last month talking about it, and it was about 21.60 a share, I think, at the time of the video. So it's been moving up as oil and other energy stocks have been moving down. Now, obviously, the uranium sector is not the oil sector, but they often have a positive correlation because obviously they're both forms of energy. And they're both subsectors of a broader sector that we call the energy sector. But obviously the oil sector in the energy sector is much bigger than the uranium sector is. Much bigger. Orders of magnitude larger. So if large hedge funds, pension funds, mutual funds want to get exposure to the uranium sector, there's only so many stocks they can buy, really. Obviously, they could buy the URA, but the URA owns all the other ones I'm talking about, including Cameco, which has a pretty large percentage of the URA or the Sprott, ETF. NextGen would be the second one. So this is a producer. This is at the permitting stage. This, NextGen has the Arrow deposit in Saskatchewan in the Athabasca Basin, the premier, deposit in the uranium space worldwide. But of course, you're paying for that. This is a $2.78 billion US market cap, even with today's 3.3% decline. So this is a very expensive relative to the fact that it's not generating cash flow, doesn't generate revenues, doesn't have a fully permitted mining project, right? But it is the best of the best in terms of the quality of the deposit, the size of the deposit, the grade of the deposit, the potential for additional exploration upside to extend the mine life past the 10 to 12 years currently envisioned by the feasibility study. Uh, According to their official estimates, they have 240 million pounds of contained U3O8 at an average grade of 2.37%. I believe it's probably quite a bit larger than this estimate. Um, but according to the official numbers, it is what it is. Um, and if you look at the uranium price sensitivity, well, you can see that currently the market is basically pricing NextGen, according to today's market cap, for a $50 per pound U3O8 outlook. So it does have quite a bit of sensitivity to the uranium price. So if the uranium price went up by 50% or slightly more than 50%, you can see that that would significantly increase the after-tax NPV. And I sort of feel like if somebody were to try to acquire NextGen at some point in the next year or so, they would be having to pay at least sort of this area $60 per pound price, maybe even a little more. I don't think that, because the outlook is so strong, and I think that at some point in the next few years, the uranium spot price is going to have to rise above $70 a pound. uh, the acquirer is going to have to basically pay for the very bullish outlook for the sector. So the market is factoring that in to some extent with today's market cap, considering the stage in the mining life cycle that it's at. So it is not cheap, but it is also the best. So you get what you pay for in life, and you got to pay up to have the highest quality asset. So NextGen would be sort of the number two play in my three-pronged approach to the uranium bull market in 2023. And then UEC is interesting because UEC has, well, it's about half the market cap of NextGen, um, but Sprott thinks it can double in share price over the next year or so. So basically get up to about a 2.6, $2.7 billion market cap in the US. And what is that based on? I don't know. It's a little puzzling. I'm not bearish on UEC, and I'm sure it will benefit from a bull run in the sector. However, I don't think the U.S. assets are particularly valuable, even though they are in the U.S. Texas and Wyoming, with Texas not coming online until 2025, and only 600,000 pounds when it does come online. That's not really a whole lot when we consider that Arrow is more than 21 million pounds of production per year. It dwarfs anything that UEC has. But obviously, time value of money, maybe Arrow is not ready for another 5 or 6 years, and Texas is coming online in 2025, and Wyoming is coming online at some point in 2024. So so UEC is benefiting from moving into fully permitted and operating mine sooner than NextGen, but also much smaller, lower grade. Um, yeah, but it is interesting that if Sprott thinks that this can be worth 2.6 or 2.7 billion dollars based upon its set of assets, including exploration assets in the Athabasca Basin, then that's a pretty nice comp for a lot of other companies in terms of size and scale and quality of assets. So I'm not a shareholder of UEC, it is interesting it has such a high short interest. I think the short interest just probably has to do with the fundamentals, the fact that it's not really a profitable company yet. I mean, penny a share, and actually expected to lose money next year. Um, and it has a more than $1 billion valuation for a company that's not profitable, that doesn't have what I would consider a tier one asset like NextGen has. But Sprott has a different opinion and makes it as its go-to stock in the uranium sector, seeing the share price move to $7 a share. So that's what makes a market. Everybody has an opinion, right? And then finally, Skyharbour. So the Athabasca Basin is the tier one address, the tier one jurisdiction in the uranium mining sector globally. It's in Saskatchewan, Canada, and it's where the world's biggest and highest grade uranium, deposits are. Cameco has multiple, deposits in the Athabasca. Obviously, we talked about NextGen, and then UEC also has a host of assets in the Athabasca Basin. So it's very competitive. There's only so much real estate, and everybody wants a piece of the Athabasca, right? So Skyharbour is an exploration stage company that is focused on the Athabasca Basin. So focused on this tier one, address for the uranium sector. Portfolio of 18 projects. Some of these are optioned out. Some of these are JVs, but they have a piece of all of these 18 different projects. And let's scroll up here. So you can see that some of the key points here, the investment highlights there. So Skyharbour is using partnerships and JVs to fund exploration across a wide portfolio of assets. So this is a model that achieves less dilution in the process, but at the same time, um, it gives a little piece away of each project in order to have exposure to more, sort of a shotgun approach. If we drill a dozen projects, surely 80 to 90% of them are not going to achieve economic viability. But if 10% do, one or two of those make a big discovery, then that is the company maker, right? And so that is Skyharbour's approach. Um, utilizing the prospect generator model to minimize shareholder dilution, keep risk down, while still holding plenty of upside in tier one, jurisdiction, the Athabasca Basin. Strong management team and technical team with a track record of success. You can see the management and board right here. And the share structure. So today it's about a $56 million market cap on the TSX-V in Canada. So I don't know what it was, that 45 million US, fully diluted. It's a little bit more, but still a relatively modest valuation considering that they have 18 projects in the Athabasca Basin, $7 million Canadian in cash and equity holdings in other companies as of year end 2022. So they have ample capital to advance their projects. Not to say that they probably will do another financing at some point in 2023, because they do want to drill and drill quite a bit. In fact, news release on November 23rd, 2022, they're going to be doing 10,000 meters of diamond drilling at the Russell Lake project in the Athabasca Basin of northern Saskatchewan. And they're going to do it in a phased approach. So like phase one drill program will be about 3,000 meters, and then expanding into a larger phase two. So Russell Lake is a newly acquired project for them. They acquired from Rio Tinto. And this has some historic intercepts that are pretty high grade. We're talking about more than 1%. U3O8 grades, which is considered to be extraordinarily high grade. If we think that today, 1% for copper is considered to be borderline high grade, quite frankly. The average head grade for most copper mines these days is down to about 0.5% or 0.6%. So 1% is actually a pretty good grade for copper. Well, copper is less than $4 a pound. Uranium is about $50 a pound. So more than 10x the price of copper. So 1% grade for uranium is extraordinary. It's extremely high grade. And the Athabasca is known for grades like this: 1%, 2%, 3%, U3O8. And that's what Skyharbour is exploring for: high grade, new discovery in the Athabasca Basin. So obviously, you can go through their deck. It's quite a well done deck, quite robust too. 35 slides, going all the way from the macro. Why do you want to have exposure to this sector, all the way to the micro, the company's projects and recent exploration news. Obviously, Skyharbour is higher risk, pre-revenue company at the exploration stage, so needs to raise capital on a fairly regular basis in order to fund expenses, including management salaries and drilling. But at the same time, this stock is in the URA. It moves very much with the sector, and you've got a lot of exploration upside from a extensive portfolio of projects in the Athabasca Basin. From a chart technical standpoint, it's very clear that Skyharbour has strong support around the 35-cent level. It's been basing out here for the last month and looks poised to move up in the new year. So I am long Skyharbour, long NextGen, and long Cameco. Please do your own due diligence. It's your money and your responsibility. Obviously, Cameco would be the lower risk one, with NextGen being slightly higher risk, and then Skyharbour being the highest risk. So I have more exposure to the lower risk and a little less exposure to the higher risk ones, as one should. And then also, please read the description at the bottom of this video. Thank you very much.